Hi, this is Dan Yerger with My Wealth Planners, and today we're just talking a little bit about kind of the market volatility, what you could be doing or what your financial planner should be doing during a downturn in order to make the best of a down market. Before we get into that, because some basic disclaimers, all this is educational. This is intended to provide you with the tools to have a conversation about it or to understand the concepts of it. It is not instructive. If you do it yourself, you own it. If your financial planner does it, they own it. This is not meant to be a how-to guide. There are always potential investment tax or legal ramifications to making investments. Consult an expert in any of these fields as needed. And finally, My Wealth Planners, LLC is a registered investment advisor in the state of Colorado. So with that, let's jump into it. So what we're talking about today requires an understanding of the concept of rebalancing. Rebalancing is very common in professional investment, and essentially what that is during a typical rising market, what you're going to see is that aggressive assets like stocks, whether those are large, mid, small, or international, or conservative assets are going to appreciate, but they're going to appreciate at different speeds. And what that means is your aggressive assets are going to typically outgrow your conservative assets. And so typically either monthly, quarterly, once or twice a year, once every year, you're going to perform what's called a rebalance. And that's going to happen because maybe you started out with something like a 70-30 portfolio where 70% was aggressive assets and 30% was conservative. Well, if the aggressive assets grew at 10% and the conservative assets grew at 5%, that means those aggressive assets are going to outgrow the conservative assets, and that you might end up with something closer to a 74-26 portfolio instead of a 70-30 portfolio. And that means you're starting to fall out of alignment with your targeted risk-reward balance. And so what you'll do is sell off some of your appreciated assets to buy conservative assets. And that might be represented here as that 5% margin. This is purely hypothetical, but that's just sort of what you're targeting, is trying to capture some of the value by taking assets that have outgrown other assets and buying other assets while they are cheap on a relative basis. So with that in mind, we look at really your two options during a market downturn. You can either hold your investments and you can ride the market, or you can try to get out ahead of time and sell your investments. And really then, if it was a long downturn and you sold out earlier in the downturn, then you got out ahead of time and you're going to book potentially some good returns. But if you got out too late, or it's a short downturn relative to when you decided to sell, you might be selling out a little bit too late, and that can be a problem. So let's explain how that happens. This is a market downturn, and this is not indicative of any index or any set of investments. This is just sort of a basic conceptual design. So bottom to top, we have just kind of market values. Left to right, we have time passing. Simple enough. And so with a market downturn, we're going to see that the market goes from a high and drops down over time into a lower value. And then at some point in the future, we would expect the market to recover. That is what has happened historically with all markets, both downturns short and long, and those that have happened quickly or slowly. So past that, we have the ride the market strategy, and that's the strategy of holding your investments over time. But the trick is you don't hold your investments only. You don't just sit on them the entire time and wait until the market recovers. There are some proactive things that you can be doing to capture value during this time. So zooming in on some of those examples, let's look at that rebalancing process. Now, before we had conservative assets gaining 5% and aggressive assets gaining 10%. But in this situation, with a down market, we're illustrating by saying that those aggressive market assets are down about 10% and the conservative assets are still up 5%. And you might go, well, wouldn't it just be down 5% and down 10%? Not necessarily. What drives a market down is rapid sell-offs. It is a mad rush or a large-scale rush to sell assets. And like with anything else, when you flood a market with something to sell, the more people trying to sell it, the lower the price has to be. And so that's what pushes the value of the market down and causes a market downturn. But what typically happens is that people don't just sell and then sit on cash. They often try to convert into something more conservative that still has some rate of return. For example, U.S. Treasuries, CDs, bonds, money market funds, that sort of thing. When they do that, that pushes the value of some of those assets up. And so by doing that, you then create a much larger margin than in the circumstance where everything was just appreciating at different rates. Now you have something that's appreciated 5%, let's say, just hypothetically, and then you have a broader market that's down 10%, creating a 15% margin between those points. And so when you perform a rebalance, rather than selling aggressive assets to buy conservative assets at a small margin, you're selling conservative assets to buy aggressive assets at potentially a much larger margin. So that's sort of the strategy of rebalancing within a down market, is to go ahead and buy assets while they are on sale relative to where they were earlier within the marketplace. Bearing in mind also that those assets will still likely be producing cash. So those stocks might still be paying dividends. The bonds should still be paying some form of interest payments on their coupons. Functionally, you should have more money to invest over this time. You won't see the value of this strategy until the market starts to recover, because the assets will still on their face value be declining. But what you'll have is more shares of those assets. And so when the market begins its recovery, the value of those assets will grow more quickly because you have more of those investments. So that's that long-term buy and hold, ride the market strategy, more or less. Then you have getting out ahead of time. This is the market timing dream. This is saying, hey, I see a downturn in the marketplace. I think I'm going to go ahead and sell out of the market early on, thinking that's going to go down a lot more. And at some point, I'll buy back into the market while it's down. And the when becomes the trick. Do I buy in while it's still declining, and therefore I end up losing out a little bit on what could have been additional margin by buying in while it was down? Do I buy it in at the lowest possible moment and capture the value? Or am I a little late to that party? Do I buy in while it's recovering, realizing that maybe it's on its way back up? And then how long does it take me to make that realization? A worst case scenario to this is selling out too late or getting out too late. You make a decision, hey, I think I'm going to get out. I'm going to sell early, or what you think is early, and then it turns out you were close to the bottom, whatever the downturn is. Market maybe goes down a little bit more, and then it starts to recover, and then it bypasses where you sold out at, and suddenly you're compounding your losses because you started out at the market high. You came down from the market high at a loss. You then sold out at a loss, locking in a loss. Then, because the market was recovering and bypassed the point that you got out at, now you're continuing to lose out in the fact that when you do buy back in, you are going to have to pay more for those assets that you used to have. So that's just the risk that you run when you try to time the market, is that you buy out, or you sell out, not early in the cycle, but late in the cycle. So the biggest problem here is, when is the recovery, and what is going to cause that recovery? Is it going to be an economic stimulus? Will the Fed or some other government pump a bunch of money into the economy and keep things going? Will there be a decline in cases of coronavirus? Is there going to be a reported effective vaccine? Or is it going to be some arbitrary political statement or action? The markets are incredibly fickle. It is a well-observed phenomenon that the price of a particular stock can spike or plummet simply because the CEO used the wrong word, and I mean literally the wrong word, in a press conference or in an investor meeting. So just be aware that sometimes the market can drop or can spike upwards for no particular reason. So that cause is very difficult to predict and very difficult to control. So really, at the end of the day, when you look at that set of choices between holding your investments and selling your investments, you really end up with three things. You can either hold your investments, ride the market, and know that you're going to enjoy some amount of return over time. Maybe not as much as you could have if you'd sold out early and bought in low, but you know that that's going to be the outcome unless the market unprecedentedly just plummets and never recovers. Your second option is, if there is a long downturn and you're lucky, you sell your investments early and you buy back in while they're down at some point, and you feel like the smartest person on earth. Good for you. Or, and this is somebody else, and this is going to happen to somebody, you decide, I finally had enough pain, the market's gone down too much, I'm getting out. And then the market recovers quickly thereafter, and then they feel like the dumbest person on earth. And on a bell curve of all the investors out there, everybody's going to fall onto the spectrum somewhere. Some people have already sold out. They're feeling pretty good about that choice right now. Some people have not already sold out. And then those people who haven't already sold out, some are just going to stick with it, ride it out for the long term. Some are going to sell out, and some are going to do so a little bit too late, and they're really going to get hurt by that choice. Others are maybe just somewhere in the middle. So with all this in mind, the question is, what's the right choice for you? That's a personal choice, but I'll just share what I'm doing as a professional financial planner. My responsibility is to mitigate risk. And so when I'm presented with essentially a choice between some level of fairly likely return or what it really amounts to a coin flip choice between do I get out now or not, I'm going to go ahead and lean towards the direction of the more likely outcome. And this comes from a number of kind of perspectives and points of education that I'll explain here. Because in your education as a financial planner, so for me, being a certified financial planner, being an accredited investment fiduciary, being a chartered financial consultant, having an MBA certified in finance, and then being a PhD student in personal financial planning, we really want to rely on data. We really want to use an evidence-based approach to making our investment decisions. And so here are some examples of where that decision to go the kind of more risk-averse, hold on to it, ride it out strategy comes from. First stop here is the Vanguard Advisor Alpha Study. Vanguard publishes this every couple of years, but this is a study that effectively shows the value a financial planner can provide. And some of it comes in the form of tax savings, smart investment selections, good investment balance, all that fun stuff. But the biggest piece of it out of everything they provide is that they estimate that the average financial planner provides a 2% bonus to the returns that an investor enjoys simply by keeping them in the market during downturns. And they illustrate that not as a plus 2%, but as a closure of potential loss. So it's not, hey, the average investment would get 10, and if you worked with a financial planner, you'd get 12. It's that the average investment is probably going to get you 8, and if you're working with a financial planner, you're going to close up to that 10 because you might sell out of the market at the wrong time, make the wrong investment decisions or the wrong asset allocation, and that's going to cost you over the long term. And that 2% can add up to a huge amount of money depending on how much is invested and how much time it has to appreciate, because that 2% comes back every single year. It doesn't happen literally every year. It's the average value over long-term periods of keeping you in the market over time. So that's the first stop. The second one is just missing the best market days. This study is done by a number of organizations over time, over different time periods. The example data I'm using here is from Putnam. They just came out with their version of it a couple weeks ago. But essentially from the end of 2019, going back 15 years, if you stayed in the market on average and never got out, never changed anything, never tweaked it, you just stayed in essentially the S&P 500 index, you'd have netted about 9.13% average annual rate of return, which is pretty good. If you'd gotten out on the 10 best days, if you decided to sell out or missed those opportunities for some reason, your investment gets cut in half down to about 4.13%. Past that, if you missed out 20 days, now you're down to an average rate of return of 1.17%. And then at 30 days and 40 days, you're actually on average losing money over the last 15 years. And again, there's dozens of variations of this from a number of different firms. And really it just serves to point out that you really do want to be careful about trying to time the market, because if you miss the bad days, that's great. But if you miss some of the good days, you might seriously miss out. Additionally, there was a study that was reviewed in the Wall Street Journal last year. I believe the article was called Even God Can't Time the Market. And it just pointed out that if you were trying to save money over time, so this is looking at something like your 401k or your retirement plan through work. If you're trying to save money over time and you had a choice between just buying into the market at large and riding it up and down and buying it when it got more expensive and buying it when it got cheaper, the add up of the compounded returns and rebalancing, the interest and dividends you'd get from those investments measured against just buying into the market with all this cash saved up on the lowest day of the market in every market cycle still doesn't add up to the value of all those compounded returns, all that interest, those dividends, everything else. So it's just a point that trying to time the market statistically just really doesn't work out unless you are extraordinarily lucky. And last is modern portfolio theory, which is a Nobel Prize winning economic theory. I won't get into too much of the nitty gritty here, but the big thing is that the investments you make, the specific securities you pick, and the timing that you buy them at or sell them at only makes up about 6% of the return in your portfolio. And the other 94% is largely made up of just what is your balance of stocks, bonds, treasuries, that sort of stuff. Timing can seem like a dramatically important factor or figure to figure into your kind of expectations for returns. It just turns out over a long period of time, it really doesn't matter that much. So whether you're trying to buy in or sell out is not of huge value to you if you have a long-term investment strategy. So here's some things you can do and some steps your planner could take or should be taking. Again, just reminding you of the disclaimer, if you take action, you are doing that on your own. I'm not going to tell you exactly what you should be doing. I'm just giving you education around what could be done. So with that, number one, if you couldn't guess it, rebalancing your portfolio. Just to summarize here, you're selling your appreciated conservative assets, which might be money market funds, treasuries, or corporate bonds, and you're buying aggressive assets on the sale that's currently happening. That might be large cap, mid cap, small cap mutual funds or exchange traded funds, preferably low cost ones that are going to kind of ride the market and not cost you too much to jump in and out of. Definitely not annuities, life insurance products, or any sort of mutual funds or investment products that come with a sales charge. You do not want to exacerbate the potential downturn by either taking a percentage off the top of your investment to pay the broker to buy into them, or exacerbate the problem by locking yourself into a long-term contract that comes with surrender penalties or deferred sales charges if you want to back out of those investments. So you just don't want to buy anything that's going to really lock us up or hurt us additionally. Second one is tax loss harvesting. This is similar to rebalancing, but this only applies to non-retirement investments. And simply put, if you have a fairly homogeneous investment, let's say a index fund that matches a large equity index where there are multiple companies that offer a similar or pretty much identical product. If you have one that you bought, let's say in January, and now it's at a loss for the year, you can sell out of that investment and buy a fairly identical or homogeneous investment that's similar to it. And then what that does is allows you to book a loss at the same time that you're buying essentially an identical investment that can be used to write off against your income and your capital gains and your taxes. That is beneficial. There's a number of important considerations in that strategy, but that's just something to keep in mind. Again, the example here is selling a large cap index fund and buying an almost identical large cap index fund. You don't want to trade out something like a small cap fund for a large cap fund or an international fund for a bond fund. It's really about kind of trading apples for apples and booking a loss on paper. Last, if you have a financial planner, talk to your planner. Get up to speed on what your planner is doing for you during the market volatility and ask questions to understand what's going on with your money. Don't accept a newsletter version. Don't accept a two-sentence email. Don't accept, hey, don't worry about it, we're taking care of it. It's your money, it's your life savings, so ask questions. Make sure that they're doing this rebalancing. Make sure if you have those non-retirement assets that they are capturing that return for you. So just make sure that they're doing something for you during the downturn, that they're not just asleep at the wheel. Your planner should be making you a lot more comfortable in that conversation. They should be walking you away from the ledge, not towards it. And the biggest thing here is if they come at you with some great idea, hey, now that the market's down, let's make a dramatic change to your portfolio. That's a big red flag, because your portfolio should, if it was invested on a fiduciary basis, have a long-term time horizon. It should be targeted for outcomes kind of 5, 10, 15, 20 years in the future, not immediate turnarounds. So if they've built a portfolio for you already, and they're coming back to you and suddenly saying, hey, now that there's a downturn, we should change everything, big red flag. Be really careful with that. And at the end of the day, again, ask questions until you're comfortable with the answers you're getting. So with that, I hope that was helpful for you. As always, if you have any questions, feel free to reach out via email or in the comments, and we'll try to get back to you as soon as we can. But otherwise, I hope you're well. And again, keep a long-term time horizon, ride the market out, and you should be all right. Thanks.